Good evening and welcome back to another episode of Please Call Me Crazy, brought to you by Free People Radio and powered by our favorite sponsor, Tireget.com. That's Tireget.com. You have to buy tires from somebody. You might as well buy them from us and help support the movement, help fund the movement. We believe in the freedom of movement, and that's exactly what the establishment wants to take from you now. I am your host, Royce White, here in the belly of the beast, Minneapolis, Minnesota, for episode number 98, I believe. Is that right, Tanner? 98? Episode number 98. Today we have a very, very special family and friends guest episode. Today we are joined by none other than Rich, the infamous Rich. Rich, tell the people a little bit about yourself, your background. Well, first of all, I wanted to bring you in today to talk about economics. I think a lot of what I see in the media right now is leaning towards the sensational, let's say. I mean, we live in sensational times, and not to say that economics and some of the things that you're going to talk about with finance isn't pretty sensational. It's in and of itself. However, there's just so much out there on the internet, and a lot of it is pretty sensational, even almost obnoxious, I'd say. And I don't mean that any of these cultural wedge issues aren't important. You pick one. There's so many cultural wedge issues. You see CNN and Fox News every single night selling cultural wedge issues and profiting off of cultural wedge issues. But the real meat and potatoes, the real bare bones of what American citizens should be concerned about in many respects is these sort of economic scams that have been run against us or that are continuing to be run on us. So I thought it was important, with all the things we've been talking about lately in the show, whether it was Maui and the possibility of direct energy weapons, and the Pentagon says they have direct energy weapons, and you got Boeing and Lockheed and all these other advanced weaponry technology, military industrial contractors, and we got UFOs flying all through the airspace now. Everybody and their mom wants to, talk about UFOs. And I'm all for that. I think next week we may, in fact, even dedicate a few shows just to UFOs, because the news is so heavy, especially on social media for people my age. But I came, into the public view recently during the George Floyd situation here in Minneapolis by bringing people to the Federal Reserve. Has been one of the calling cards of my time on the public stage as a political figure. They would call it on Wikipedia, I guess. So I'm very into American citizens having the financial literacy to understand, one, their own financial situation, but also the institutions that govern over them financially. So with that being said, Rich, tell us a little bit about yourself, introduce yourself, tell us a little bit of your background, and then we'll go from there.
Sure. Thanks, Royce. It's good to be with you tonight. So a little bit about my background. I got into onto Wall Street back last century. I started on Wall Street in the late 80s, early 90s. And I started in the world of foreign exchange and foreign exchange derivatives. So derivatives are just options or futures that are traded on an underlying product. In this case, it was the foreign exchange market. And I started on one of the exchange floors in Chicago, but the firm that I worked for was bought out by a Swiss bank, which then decided to move a lot of us all over the world. And I had studied Japanese as well as finance in college, and so I was moved over to Asia, initially to Tokyo, then to Singapore with a stint in Hong Kong as well. And I spent the better part of the 90s in Asia, working and running not just foreign exchange trading operations, but also ultimately Asian emerging markets, et cetera. Responsible for all of the Asian businesses for a couple of different investment banks in the global investment banks are, where I was heading the Asian operations. I decided to move back to the U.S. in 2000, just in time for the tech bubble to crash, et cetera, and moved into work in hedge funds and spent the next the next 20 years working in hedge funds, a couple different hedge funds, running a number of different products, et cetera. And again, moving overseas. This time I'd moved overseas to Europe and spent some time, 4 years living in London to run the European operations there. And then after 30 years of working on Wall Street, um, I decided it was time to kind of focus on a little bit different thing. And I was surprised because I've been started to teach at my alma mater, University of Illinois. I started to teach there when my daughter went there, and I got re-engaged a little bit. I found that I was starting to teach and work at the same time, and it was just a little bit too much. And so I asked myself, what do I like doing better? And I was actually a lot happier after a day of teaching than I was after a day on Wall Street. And so I decided to do that full time. And now I'm going in my 5th year of teaching full time. And so I teach finance, a range of different subjects, from things that I've built my career upon, such as derivatives or investment management or portfolio management. But I also teach a class called Finance for Non-Finance Majors. I'm with you on terms of financial literacy. This class is geared towards people that aren't business majors, that aren't finance majors. It's English majors, theater majors, biology majors, whoever it is on campus that wants to learn a little bit more about how they should maybe invest their 401k, or how they should consider a rent versus buy decision, or how they might want to start or fund their startup business. And so I'm just trying to help those students to learn a little bit more about finance that just can help them out a little bit, kind of get through the economy. And so that's the bulk of what I've been doing. And then now, as I've been teaching the last several years, I've gotten a lot more engaged in terms of social media. I'm pretty active on LinkedIn and Substack, again, with a goal of what I call demystify finance, which means I just want to demystify finance and make it a little bit more accessible for the regular person out there.
And so, let's. Last week we ran a special where we basically replayed G. Edward Griffin's dissertation presentation on the creature from Jekyll Island, and he talked a lot about the inception of the Fed, and over the last 3 to 4 years, PBS Frontline as a broadcasting or organization has spent a fair amount of time covering the Federal Reserve. And what they call the power of the Fed. And one of the phrases that's popular on Wall Street, I guess, is don't bet against the Fed. I'm not a finance guy, but I'm watching these people like a hawk. So, the Federal Reserve has become a very big piece of the conversation politically, at least underneath the surface. I mean, everybody talks about their own personal finances, especially around political season, how much money's in your bank account, what's the cost of food and gas, blah, blah, blah. But how the whole system kind of works. Give us your take on the Fed and just kind of how the monetary system works from a macro level that most people may not understand.
Sure. I mean, if we go back 1913, right, when the Fed was created the same year that the income tax was put into effect, right? And so essentially the Federal Reserve, there are some and many that would believe that the Federal Reserve was kind of created essentially to make sure the income tax is working through the system, and that's one of the ways that we've kind of lost a little bit of control, if you will. But I think for the better part, if we look at from that inception date, really up to and through the financial crisis, the Fed did what many thought it was intended to do. It was there to kind of smooth out business cycles. It didn't eliminate business cycles. It was there to smooth things out, because the Fed, Congress gives it a dual mandate. The two mandates are basically growth and inflation. And the way they measure that growth, if you will, is the unemployment rate. They want to have full employment. The government obviously wants to have full employment. Consumers want to have full employment, right? And so that's the Fed's mandate, is to try to maintain full employment. And the other one is price stability. And so for the most part, no one really cared about the Fed. The Fed would move its short-term interest rates around to smooth out the cycles. And when things got extreme, the Fed got a little bit more involved and took control. And we saw that in the late 70s and early 80s, when inflation was out of control for a lot of different reasons. We didn't have energy independence at that time, et cetera. And that kind of led to wage price spirals. But inflation was out of control. And so the Fed stepped in and was very, very aggressive. Paul Volcker came in and essentially crushed the economy to bring down inflation. And that, that's part of their mandate. And so then what that started from essentially 1982 until last year was a 40-year bull market in bonds. So yields kept falling from double digits, 17, 18%, all the way to 2021. We had the low in the 10-year Treasury yield of 50 basis points, right? So it was a 40-year bull market in bonds. And what that meant is that was, in some ways, there was a positive to that, right? That lowers the cost of financing for everything. It lowers the cost of financing for American businesses. It lowers the cost of financing for equities and companies that want to issue equities. That helps people's portfolios of savings. It lowers mortgage rates, et cetera. So there was a positive to that, right? But I think what's changed after the financial crisis, which has really brought the Fed into play, is that the Fed has become a lot more active. It used to be that the Fed would only use interest rates to, quote, smooth out the business cycle. And then what we've seen since the financial crisis is the Fed using its balance sheet as well. And that's what I think has a lot of people saying the Fed's maybe overstepped their bounds. They've used what we call quantitative easing, extraordinary measures. I think Ben Bernanke referred to them when they first came in. And not only have they not shrunk since they were put into place, but they've actually grown quite considerably, right?
Right.
The Fed's always had a balance sheet. The balance sheet was very rarely used. I think if you look at it, it essentially was in the single digits as a percentage of GDP for the history of the Fed. Post that period, we moved up to about 15 to 20% as a percent of GDP post financial crisis on these extraordinary measures. And everyone said, okay, that's not great. But at the same time, if you remember, post financial crisis was a pretty ugly time, right? People were losing the houses, they were losing their jobs. And so in times of crisis, I think, who was it, Rahm Emanuel, that said, never let a good crisis go to waste. Well, they didn't let a good crisis go to waste and took control, but people were pretty happy with it, right? Now, what's happened, though, is that the expectation was that when things got back to, quote, normal, that we're going to go back to single digits as a percent of GDP, and would, again, it was extraordinary and would just not be something that we talked about anymore. However, it never really came down, and every time the Fed tried to bring it down, there was some market turbulence, and the Fed would immediately kind of grow its balance sheet right back. Then post-COVID, we went from 15-ish% of GDP up to 30%, doubled again. It added more to the Fed balance sheet than we did after the financial crisis, all in a very short period of time, right after COVID. And, again, that was a lot of people panicking, lockdowns, et cetera, so they kind of allowed it to happen. The Fed started to try to unwind some of that earlier this year, and we had a little bit of a mini banking crisis in March, and immediately the balance sheet went right back up. And so while the Fed has been removing some of this stimulus via raising rates, its balance sheet, which is running at 30% of GDP, has not come down. And that's, I think, where a lot of people say that we have an activist Fed that's really trying to control the pricing of risk assets and essentially, in some ways, kind of distributing the risk to where it wants to see fit. Choosing to buy mortgage-backed securities when it wants to, choosing to buy corporate bonds when it wants to. By law, the Fed can't buy equities, so it doesn't really buy equities at all, but it doesn't at all. But the relative pricing will, of course, impact the equity market. And if we did a simple overlay and correlation of equity prices versus the size of the Fed's balance sheet, you would find that there's a fairly tight correlation since the financial crisis. Before that, there was no correlation whatsoever. So I think if we go back and go look at pre-financial crisis, I think most people would say the Fed largely did its job. In fact, in my first 20-ish years, if you would, on Wall Street, we never really talked about the Fed. The Fed was there maybe at extremes, and otherwise you never really worried about it. Mm-hmm. The last 10 to 12 years on Wall Street, that's all we talk about is the Fed. No one really talks about anything but the Fed. And so I think that clearly the story and the narrative has changed from one where the Fed was only involved at extremes to where the Fed is involved in every single part of what's pricing in the asset markets on a day-to-day basis. And so I think that's a pretty meaningful change, and that's where I think a lot of people would now say that the Fed has clearly overstepped its bounds.
Okay, let's go back here and kind of and unwind this for the layman, and I hate to do that because people always tell me, bring it down for the layman. I really can't stand that. But around these financial issues, I know a lot of people are going to sit there and go, I don't even know what you guys are talking about. I have no clue.
Yeah.
Let's talk about what it is that what underlies the Fed's, what underlies a financial term like inflation? What underlies the Fed's mandate to be at full employment? And in that respect, because I know you worked in foreign markets a lot, is it your theory of the case or is it your assessment that in the 70s, as the Fed started to become more active, coincidentally is around the time where America made moves into foreign markets. Did these moves into foreign markets affect the overall employment, and were these things kind of convoluted in some way that you can see from looking back at history? I mean, everybody talks about us going into China. If the Fed's mandate is to maintain full employment, obviously its political sway, or the political sway on it, uh, will come down to bear on the American people. But there seems to be this entire other economy that works outside of the scope of America's borders, America's political governing bodies, and America's, let's say, financial institutions, right? I mean, there's this whole global market that the Fed is playing in. So tell us how that works. If the Fed is supposed to keep employment high, I mean, wouldn't it be the Fed's mandate then to go into the Nixons and people like that at the time and say, hey, if you start to ship our jobs to China, and then if you reward big companies, Wall Street, for going to get cheaper labor in China, you're going to inflate you see what I'm saying?
Yeah, no, I hear what you're saying. I think, well, we gotta look at it. There's a few things there to unpack.
Okay.
So let's start with where the Fed kind of gets its legal mandate, if you will, right? The Fed's legal mandate comes from Congress, right? Congress, people elected by the people, and so essentially the people, in theory, have given the Fed its mandate. Okay, we can argue or discuss whether or not Congress is actually doing its job or not, and I mean I think that's a fair question.
Yeah.
But that's ultimately where that's who instituted and started the Fed, and that's who gave Fed its marching orders, if you will, and said that we want you to focus on full employment and price stability. And if you think about it, that's through time. Those are the two issues that the U.S. people have faced, given the Great Depression in the 1930s. And the rapidly high inflation in the 1970s. And so you can kind of see the logic for where that comes from. Not every central bank has the same mandate. If we look at, for instance, the European Central Bank, which it's obviously a slightly different union because it sits on top of an organization that has 27 different countries.
Right.
But if we look throughout Europe, their mandate is sole. It's inflation only. That's all they care about. They don't have a full employment mandate. And that leads to different policy choices, right? So, for instance, right now, inflation is still very high in Europe, while the economy looks like it's about to go into recession. In fact, it's going into recession because inflation is high. Yet, what is the ECB doing is raising rates. And it's doing that because it only has a single mandate, which is to bring down prices. And famously, it did this right before the financial crisis when the economy was going into recession, but prices were high. It was still raising rates, even though it was pretty clear to most people at that time that things were going to get pretty ugly pretty quickly. And so that mandate, if you will, kind of leads to policy decisions. Given that the Fed has this dual mandate, these trade-offs between employment and prices, it has a little bit more flexibility in what it does, right? So even though inflation is stubbornly high, and we got an inflation report this morning which moved back higher, and it's above the Fed's target. The Fed has a target that it wants inflation to be around 2%, right? And let's look at it in terms of CPI. The Fed might use a different measure, but CPI I think is in the news. I think a lot of people are familiar with what the CPI basket, consumer price inflation, what it means. And that 2% isn't just arbitrary. That's essentially, if you look at for the last 130 years of America, the average inflation we've had is 2%. And so they're trying to keep it about average, okay? And if it's below 2%, they're trying to ease policy to bring it back up. And if it's above, they're trying to tighten policy, bring it back down, and that's where we are right now. So what's the trade-off then between jobs and inflation? Kind of getting back to your point then of when jobs were getting shipped overseas, not just in the 70s, but even during NAFTA, et cetera.
Late 90s, yeah, exactly.
Yeah. Should the Fed have been going to Congress or going to it goes before Congress twice a year, but could the president have called in the head of the Fed to talk about that? Sure. The head of the central bank is an advisor to the president. It has to report by law to Congress, and so it is responsible. And I don't recall all the different those testimonies they call Humphrey Hawkins testimonies after the senators that put him in place. I don't recall exactly what was being said, but it was pretty clear though that in some ways the jobs moving overseas And you remember at that time we had really, really high inflation, so the Fed was trying to bring it down. Those jobs moving overseas and the lower costs that would result actually made their inflation job easier. So it's not entirely clear to me that the Fed would, on the one hand, full employment was going to be more difficult, but on the other was going to help them in terms of inflation. So there was a trade-off there, and so I would think that there was probably some discussion about what the trade-off looked like, and there was something, and not to get wonky on you, but there's something that academics look at called the Phillips curve, which is the trade-off between employment and inflation, and it suggests that when unemployment gets too low, so when employment gets really full, we're naturally going to see inflation because people have choices of where they want to go to work and they're going to ask for higher wages, et cetera. Largely what we've seen through empirically the last 20 years or so is that hasn't really been a trade-off that way you would expect, the way that we saw in the 60s and 70s. And a lot of that lack of a trade-off, that lack of pricing power for employment, if you will, the lack that consumers didn't have the ability to go and ask for higher wages, had a lot to do with the fact that we were looking at this global labor pool. And if you ask for higher wages, they just ship your job off to another country. And so there, so that
And is
in
that
some
so?
ways that
What,
argument has been debunked a little bit.
well, and well, there's two questions. One,
Yeah.
you know, in my circles, we talk about in my immediate circle when we talk policy, especially economic policy, and we look at the history. You can't overlook the impact that the unions had on corporate America shipping its jobs across the water as well. And that while I think unions are an entirely different rabbit hole to get into. Are you for? Are you against? Should the citizens have the right to form a union? Absolutely. I mean, it's just they should have the right to do so. Do
Yeah.
unions have unintended consequences? Absolutely. And one of the unintended consequences that many working class Americans didn't really take into account is that the union gained so much power, or unions gained so much power, they effectively justified corporations in Wall Street sending these jobs to places that were not well unionized.
Yeah.
um, and so there's a whole question there of, did the unions push too far, and if the unions did push too far, who may have been behind that? I mean, was that organic, an organic thing that happened in the workers' movement, or were there some other forces that were at work there that understood that would happen? Um, and then again, there's a give and take there as well. You could argue in the same sense that the corporation at the time had free reign to be extremely greedy under American corporate policy at the time, and they and then it's funny because people talk about making America great again, and I would say by many metrics, and you look at the safety, national security, self-sufficiency, the independence of America, the manufacturing, so to speak, and a number of other things. The 70s, this time period where things started to change, was the time period, maybe the 50s. Okay, you could say maybe between the 50s and the 70s, from an economic standpoint, is when America was kind of at its greatest, coming off of a World War II, and we had this huge industrial, movement. We had huge prosperity all around the world. We had huge global hegemony with the dollar, newly founded global hegemony with the dollar. So there was all these great things happening at that time. And right away, I mean, as soon as we kind of gain this stability, this sort of radical globalization starts to happen, and we start to lose it. I mean, almost as soon as we get it, we start to lose it. And if you look at the time, get a little bit more in the details, it's not as rapid as I'm making it, obviously, on camera, but it definitely came and went, and now we're completely dependent on other markets for any number of things. Can you talk to me a little bit about how you see America's dependence or lack of independence having a huge effect on Americans' economic prospects? I hate to say their bank account, because to me it's like, yeah, you have a bank account, you have how much liquid cash you can get your hands on, how much it costs to pay your bills, how much it costs to feed your family and fill the refrigerator, gas up your vehicle. But even more importantly, I think, we've tried to introduce this idea that there's a value to your citizenship, and that value to your citizenship is economic, but it's other things as well that sort of encapsulate the net value of being an American citizen. Um, Talk to me about just your view on globalization in general and how it's affected American citizens over the last 40 years.
Yeah, that's a good question, and that globalization on net, I would say, has been a positive for Americans on net. Now, that doesn't mean it's been a positive for all Americans by any stretch, right? And let me tell you why I say that. And I'm not, and things, the pendulum does swing too far at times as well. And as we saw, I think in COVID, it had swung too far, and it is adjusting. But as much as a lot of jobs were lost, and they were lost primarily in the Midwest, right? When I'm in Chicago, you're up in Minneapolis, we felt it in the Midwest more so than any other part of the country, for sure. But what did America as a country, what did it get in return? It got a lot of cheap products back, right? It got a lot of cheap products back from the rest of the world, initially from Mexico. Then the production was shipped to Asia, and China, then Vietnam, et cetera. And then you had Walmart come in and all of its production overseas. Amazon took over from that mantle in some ways, and Americans were able to buy a lot of stuff, right? We were able to buy a lot of stuff, and in some ways, if you measure your kind of quality of living, or your standard of living based on how much stuff you have, Americans are doing better now than they were doing in the 1950s or 60s or 70s in terms of how many Americans have two cars in the garage or have more than one television.
But Rich, wait, one second. One second.
I'm just saying that's a one way you can look to measure it.
But no doubt, no doubt. But isn't that sort of the Fugazi already? I mean, in the whole deal. I mean, part of the Fugazi in globalization, in my opinion, is this idea that it's part and parcel of what becomes a problem with economics and finance, especially big finance, global finance in general, is the metric of a person's quality of life. If it's driven by this sort of radical materialism, and I know it gets hard, right, when you're talking numbers, and especially you're talking business and economy and finance and markets and products and trading and goods, and it gets hard not to talk about the material aspect of it, because I mean it's all material measures.
Yeah.
But in many respects, I mean, the products that Americans got were really. Did they really improve the quality of life? I mean, you're a teacher, for example, and it would seem to me that like a lot of the products that Americans got in exchange for this globalization only decreased the amount of people on average that would have any basic understanding of the type of things that you discuss. It's why I sit here as the host of the interview and think to myself, they told me when I ran for Congress that most people don't read above a fifth grade reading level in America. And
Yeah.
I don't know when that started. I don't know how long we've had that literacy crisis in our country. But if that's the case around regular literacy, then I would assume financial literacy is somewhere in the same ballpark, if not worse. I would venture to guess it's much worse.
Yeah.
But didn't a lot of these products that we got, and for example, an institution like the Fed or other institutions, other governing bodies, wasn't it incumbent upon them to kind of assess the overall health of the country against the economic potential and say, hey, yeah, we're going to get a lot of cheap microwaves and toasters from China or Japan or wherever it was, but the huge trade-off is that the American people are going to become dumb. We're going to become consumer whores, is for lack of a better term. I mean, do you see that trade-off from I know you come from an economic lens, but is that something that we could look at and say needs to be considered?
I think I don't disagree with you that literacy, especially financial literacy, is quite poor and needs to be improved. I guess I don't see the direct linkage between that and globalization, because I think there's different things at play. And one thing I was going to say is there's the trade-off that we have between the jobs that were lost in one part of the country, largely, right, the Midwest, versus the total country benefiting from more products, if you will, right? And then yeah, whether or not we should be materialistic or not, I'm 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 willing to side with you on the fact that I don't think we should be, and don't think we should be so focused on that. But I'm just watching what Americans do, and Americans are consumers by and large, right?
You're
75% of
saying
our
what?
economy
Yeah,
is consumption. So
what Americans have chosen, and this is important.
yeah,
I would agree with you here that you know, in all fairness, we get to sit here as commentators or as people who teach and look at people in leadership. It's very easy to look at people in leadership, but really we're best looking at ourselves. I mean, that's an old adage that I think never gets old, right? Is look
yeah,
in the mirror, and the American people, we the people, we chose globalization. I mean, we did choose this radical materialism that allowed our jobs to be shipped, and even the unions, right? I mean, if you look back at the whole union movement, when the unions pushed as far as they did, and the company said, "Okay, we'll take our products over here." There should have been a massive union boycott. I mean, if their belief was ideologically driven, like
yeah,
down to the bone, then the unions would have said, "Hey, we're not buying any products that come from China either." I mean, the entire
yeah.
workforce is gonna go, balls deep on the ideology, and they didn't do that. They took their high-paying union wage jobs, and they took the cheap products that came from China from the jobs that went away from them, which was, is a real indictment of the American people. Keep going. I just wanted to add that in
No,
for people
I think
watching.
your point's taken, and when we think about those, I mean, listen, I think everyone, like you said, has a right to form a union, and the union has a right to collectively bargain for higher wages for its members. But I think it's a trade-off, right? There's no obligation that the company has to pay those, and if the company can source that lower, that's a risk that the union takes in asking for higher wages, in my opinion. And sometimes it can't source them cheaper. Sometimes it can source them by moving to Alabama or Tennessee. It doesn't even have to move to China, right? And so you get moves to non-union states, and we've seen that with the automakers, et cetera, where they've moved to non-union states. And so, I think that's a risk that you make, right? When you say we're going to get together and we're going to ask for something more, you have to be willing to like take the risk of that. And I think some of that was outside of the control, and then, like you said, this globalization, which I think, as I said, clearly happened. I think had gotten to a pendulum. The where I think as a country it is clear they got to a pendulum is like we do need to have some sort of industrial base. We can't be entirely reliant on other countries for everything that we have, right? And I think that is something that's fairly clear. And I think there's two trends there that are kind of going on, right? And one of them is this idea of rationalizing supply chains. So companies, you kind of go back and you can pick on Jack Welch and GE, but he was kind of the leader of it at the time, saying that he wants to make things in the cheapest place you can, and that's kind of goes back to get all wonky. There's an economist back several hundred years ago, David Riccardi, who called Ricardian equivalence, said and comparative advantages that if country A can make something cheaper than country B, country A should make everything and send it to country B, and then country B should make whatever it's really good at, right? And so the argument on that basis from an economic theory standpoint is that the U.S. wasn't really good at making cars. Other countries were better at making cars. What was the U.S. really good at doing? It was really good at making movies. We made a lot of movies, right? That industry took off. The country was really good at financing startup companies, et cetera. When you look at Wall Street, you look at venture capital, you look at technology, et cetera. The U.S. did a lot of that. And so the U.S. was doing the things it did very, very well, and it was outsourcing what it didn't do well to other countries. Now, the education within that's kind of wrapped all around that. So when there's those adjustments, and I'm not one that thinks the government should get involved at all. I think I kind of would rather have the government not involved most times than not, because the government, in my opinion, typically doesn't do things better than private enterprise can. But when we have those painful adjustments where the country overall may benefit, but certain pockets of the country do not benefit at all, in fact, are in much worse shape, that is a case when the government should step in and say, okay, now what are we going to do? How can we retrain and requalify these people for these jobs that we think are going to come because America's good at doing some other things, right? Could we have trained more people in the Midwest at filmmaking, at finance, et cetera? And I think that we could have done a much better job in that. And that's where there's the failure, I think, is in looking and identifying that situation and not fixing that wrong when we had the chance to do it several decades ago. And now now we're a couple of decades behind, right? Now, when I talk about the pendulum swinging back, we are seeing the pendulum swinging back. We're seeing companies trying to rationalize that supply chain, saying, I don't want to just make it. It's not just where I can find the cheapest labor, but I have to think about transportation cost. I have to think of reliance of my supply chain. We saw during COVID and some of the supply chain disruptions that we couldn't get things when we wanted. And so now you're starting to see this trend towards onshoring or nearshoring or friendshoring, as they kind of different companies call it different names. And really what it means is they want to make things closer to where they sell them. And so if they're selling things in the U.S., they want to make it in the U.S., but maybe it's in Canada or Mexico because we've got the trade agreements in place. It's going to be somewhere in North America.
You can
in
walk
Europe,
there.
It's not going to be made in Germany because it's expensive to make it in Germany. It's going to be made in Eastern Europe where things are cheaper and then sent into Germany. And things will still be made in Vietnam and China, but it'll be sold in Vietnam. It'll be sold in Asia overall. And so companies are still, what they're doing is they're spending more money to build multiple manufacturing plants around the world instead of having one engine of manufacturing that kind of service the globe. And that's a trend that will take at least a decade, right? We're probably 3, maybe 5 years into that trend. And it's going to take 10 to 15 years, right? It took 10 to 15 years for us to globalize everything. It's going to take us that long to deglobalize it in many ways. Now, will that fully benefit American workers? Partially, yes, right? There'll be more jobs for Americans because of that, but the 10,000 person factory isn't coming back. If that factory is coming back, as we've seen them built around the country, one, they're going to where states are offering incentives to build that, but two, they're being done with a lot of robots, et cetera. And so there's instead of 10,000 people, it might be several hundred people working in those factories, but it's not the factories that we had in the 1970s by any stretch. To kind of add on, I know I've gone on here a little bit, but there's another trend underlying all this as well, and that's a focus of company managements on stakeholders versus just shareholders. And so 1972, Milton Friedman wrote a piece that talked about how company managements should only focus on maximizing shareholder value as kind of the famous piece, and people want to point to that and say that gave CEOs carte blanche to just really focus on lowering costs and driving stock prices higher. And that's what happened. That's not exactly what Milton Friedman said, by the way. What Milton Friedman really said was company managements work for the owners of the company, right? They are agents. They're not principals. They work for the owners of the company, and so they should do whatever the owners of the company tell them to do. And that's what Milton Friedman was saying. And if the shareholders are saying we want to drive the value of our shares up, that's what management should do. What we are seeing increasingly now is that shareholders are saying, yes, we want our share prices to go up, but we want you to focus on our communities. We want you to focus on the environment. We want you to focus on employee well-being. And so that's all of the stakeholders involved in the process. And so we've seen this with the Business Roundtable, where 180 plus CEOs have signed on to say that they are going to focus on all stakeholders, not just share price, not just in lowering costs, but on the communities in which they live and work, on their employees and on their customers as well. And we've seen more of a trend of that, but we're still in the early stages of that shift. And so there's a lot of things that are shifting away from that kind of 1970s, 80s mindset towards lowering costs and globalization to kind of a more holistic view, if that makes sense.
Yeah, yes, for sure. And on face value, right idea on face value. Who's implementing it is certainly a concern for a lot of people, and
Sure.
what their motivation is. I mean, because in the inception, you say, okay, like you mentioned, do whatever's best for the stock price, drive the share price up, which really meant do what the owner says. The owner has an economic incentive to maximize profits. I mean, that's just what we saw. Or, you don't need incentive, just basic human greed. Let's just say the level of altruism and humanitarianism was not once what it now projects itself to be today. And I say project because, again, I mean, there's a huge concern now that the global corporate community has had a significant swell in their uh, monopolization on any number of markets across the world, and that they have this sort of collective ideological mindset that they're trying to frame up. Not that individual people won't break off and do their own thing and have the ability to be very impactful, influential, have a lot of success in their own lane. But there certainly seems to be a serious effort, an effort that's more promoted, maybe that's promoted maybe now more than ever, to bring the corporate community together along some of these more holistic ideological viewpoints. And I think the telltale sign is something like the corporate equality index. Um, yeah, I think it's the corporate equality index, and third. It's a private. I don't want to call it a think tank. It's a private organization that was funded by Soros, and I don't mean to go conspiratorial, because certainly the New York Times doesn't want me to say George Soros' name at all. But anyway, his foundation funds the Corporate Equality Index, and the Corporate Equality Index is acquiring the allegiance of many global corporations around certain societal issues that have been deemed important. Some of what you said, much of it is race and equality of gender and sex. A lot of it is the environment. Those are kind of the two railheads of that push. And so, now we're in a dangerous position where the corporation sort of gets to tell us how to live, right? And they have this ability to impact policy, which has long been considered a problem. I mean, the corporate lobbying of the politics in America has long been consensus a huge issue, right? But now they're kind of coalesced around these particular issues, whether it be race or race and gender together, or the environment. And so now we're seeing a penalty placed on corporations who won't fall in line. And I just want to ask you, like, in a completely, not a different direction, but as a slight tangent, to go back to the Fed and the interest rates. I'm starting to see somewhat of a correlation between the Fed's impetus to raise interest rates and bust out the middle market to make more companies have to either sell upstream to bigger corporations, or just straight bust out altogether and file bankruptcy through the interest rates. And as that happens, don't we see a swell upstream to bigger box companies, even a bigger sort of globalization that is anchored around these ideological these ideologies? I mean, again, the interest rates, for example, anybody who has a loan right now, you can tell maybe I'm wrong, but anybody who has an open bank loan and they work off that working capital of the bank loans, or they have a line of credit, and right now, the interest rates, and then coming off of COVID and the supply chains being, I mean, isn't this all a matter of national security in some sense? Number one, but number two, they're going to bust out the middle market. How dangerous is it from your vantage point as somebody in finance to have a vulnerable middle market? I'm not talking about the middle class. I'm talking about the middle market. I'm talking about the mom and pop shops that used to make America what it is. Now, if everything becomes Walmart, don't we lose a certain sense of sovereignty economically as citizens and local communities in that regard?
Yeah, I think that's a fair point, and we are clearly seeing in what, I mean, a lot of people will point to the fact that the economy is stronger than expected, than many people, myself included, expected it would be this year, and the stock market is stronger than many people, myself included, thought it would be this year, et cetera. But if you look underneath the surface, it's a few companies that are doing very, very well, and that's driving everything, right? If you look at small businesses, 99% of companies are small businesses, right? Small businesses employ almost 50% of all workers in America. So small businesses absolutely matter. Small businesses are struggling. We see that in the small business surveys where they tell us they're struggling, where they tell us they're not going to hire people, where they tell us they have to raise prices because they can't afford to kind of keep doing work. We see the banks saying that they're going to make credit more difficult to get, and that's for all companies, not just small companies, but it impacts small companies more than big companies, right? And so, yeah, small businesses are absolutely getting hurt, and the Fed has said it's going to slow the economy, intentionally slow the economy to bring inflation back to its target. Inflation is still well above its target. Unemployment rates are still very, very low relative to history, and so it has the kind of the wiggle room on its own. Again, going back to its mandate, since unemployment's low and inflation's above its target, the Fed's mandate is to bring inflation lower, and it's saying it's going to do that by slowing the economy. And we're seeing that in the small companies. We're not seeing that in the large companies. Is it is the Fed trying to squeeze the small companies and not the large companies? I think the Fed's tools are very blunt tools, and I don't think they have the precision to be able to do that. I think they're trying to slow everything, and it's just that the small companies are going to get hurt first. And if the Fed does what it intends to do, I think everyone ultimately will get hurt. But we're just seeing it happen in the small companies first. I think the monetary policy is such a blunt instrument that it can't, with precision, try to target certain parts of the economy. It's just trying to slow the economy overall.
Yeah, no doubt. I mean, yeah, that's true. That's true of all policy, with some respect, because people have a tad bit of arrogance around the ability to affect unintended consequences. People are not so good with. Obviously, we're human. But
can I just jump in real fast though, to your point? Sorry to interrupt, but
go ahead.
When we think of the two different types of policies, right? We have monetary policy and fiscal policy, right? Monetary policy is intended. It's like I said, it's very blunt. It's intended to smooth out the economy to the extent that it can. It's not perfect. When we get to extremes, when the economy is too slow, the goal is to step in and try to spur it back higher. When the economy's running too hot, the goal is to try to bring it back down. But it's very blunt. It's going to have winners and losers in all of that, just because that's the way the policy is. Fiscal policy, Congress, which is a slower moving body, which can't step in and do things on a weekly basis or a monthly basis as the Fed can. Congress takes longer to act, but Congress does have the tools to be a little bit more precise and to say these people are getting hurt, these people are getting helped. Let's balance that out. And Congress has a little bit more precision in its fiscal policy toolbox.
Yeah.
And so if there's precision needed, I would probably point to Congress more so than the Federal Reserve.
No doubt. No, the Congress has been found very lackluster on the job around any number of issues, but especially monetary policy. My question is, let's pull the lens back even further, if that's even possible. I mean, we're up there. We're high up there in the altitude for people. Let's pull it back further, but make it more simple. At the time when the Fed was instituted, there was definitely a very different attitude towards work, human beings, work, and the prospect of energy or growth economically across the board. Why? I mean, in the early 1900s, the technology was so far behind where we are right now. I mean, how far we've come in 100 years is it's unbelievable. It actually is quite unbelievable to think you had to, rotary phone, and now I can Skype with you from Minneapolis to Chicago instantaneously.
Yeah,
a modern marvel to say the least. Comes with consequences. Comes with a lot of unintended consequences. I'm not anti-technology, but what I'm saying is there seems to be this runaway train now that even in the earliest days of the Fed, people couldn't have perceived, and now people have to ask the question, especially people who are leaders in economics and finance and policy. What is too much technology, right? I mean, like part of the inception of the Fed, or as I recall, or as I've read, or part of the entire industrial boom was, hey, we're going to give people credit because it's a net positive for everybody, right? I mean, We're going to have growth. We're going to be able to build. People are going to have jobs on the way. They're going to be able to get money, and the whole economy grows, and people have trouble understanding that there's your individual economic growth, but the economy as itself can grow, and that's based on human production and human energy and human population and all these other things. But there was a real, I want to say, spiritual investment, at least in the fact that human beings were going to be a part of whatever it was that was done financially, corporately, globally, economically, etc. Now we've come to this place technologically where it's very obvious there is a path, there is a vision out there, there's a horizon we can see where humanity is less involved. So from an economic standpoint, although isn't this a moment in history where it may be incumbent upon policymakers, government, and even people who are in the private sector to step up and say, hey, business to a certain point, but at the moment where we start lapsing humanity, we have to ask serious questions. Because, for example, I mean, there's a movie coming out. What's the movie coming out this week, Tanner? There's a lot of, with the robots, with AI. I forgot. I forget what it is, but they had a few like robots at a baseball game, at a football game over the past weekend to kind of promote the movie. I forgot exactly what it's called, but anyway, AI, ecto farms. I mean, where we're going with technology is going to be even more unbelievable in the next 10 to 15 years than it was over the past 100 years. And a huge piece of that is we don't need human beings to work. I mean, human beings in work has a business and economic function, but there's also a very human spiritual function, so is there a way to factor that in and still maintain some of the fundamental aspects of economics that we've built the country on?
Yeah, I mean that's I would that's a tough question. Yes, I mean I think any business leader, anyone involved in this, there's an ethical question, right? And I'm a member of the Charter Financial Analyst Society, and a big part of our charter, a big part of our mandate is looking at ethics. And so, yes, I would agree that there's a huge ethics component to AI, to robotics, et cetera. You mentioned ecofarm, anything we're doing, biologically, et cetera. We always need to be asking ourselves that question. And there are many studies out that would suggest that artificial intelligence is going to massively disrupt the working population for sure, right? It's going to make a few people incredibly productive, but it's going to cause a number of other people to lose their jobs. And so in some ways, it's a microcosm, maybe it's a macrocosm, maybe it's bigger than what we saw, of what we saw with globalization, right? Some people are going to do very well because of that productivity increase. Companies might do well, et cetera. Cities where AI is really kind of focused might do well, but there are going to be a lot of people that are left out. So how do we then kind of take care of those that are left behind? I think, I can certainly see a very negative outcome in the way this plays out, but there's a positive spin on this, or not spin, but a positive way to interpret this, I think, is comparing this to the printing press, right? Before the printing press, which was this revolutionary technology when it came out, very few people had access to books. And books that were around were kind of written by hand or copied by hand, et cetera, right? And so a lot of people weren't literate at that time because no one could really afford to own a book. Then the printing press comes out, and all of a sudden now everybody could afford a book, and then literacy went up. So AI, there's a lot of people that don't understand how to code. There's a lot of people that can't code to get their questions answered. But AI also makes a lot of this technology, a lot of this power, a lot of this data analytics, a lot of the computing power that we have more accessible to the common person, because now instead of having to write a line of Python code or R code in order to get an answer back from a computer, I can just type into a chat GPT field the same way I would in Google and ask it some questions and start to get some answers. Now, it's still fraught with a lot of problems. I can assure you that, right? And you're not going to always get the right answer. There's the hallucination that these engines can do, et cetera. Yeah. And we're seeing subsequent iterations of these large language models, in some ways getting better, in some ways maybe getting a little bit scarier. But I do think there's a power that comes with it, but we do have as a I wouldn't put it necessarily entirely on the private markets. So I would say the private markets are the best to handle it. But as a society, we absolutely have an ethical question around how we want to see this deployed. Ultimately, I think, and then it kind of goes back to some of your other questions before, is if we see companies acting in an irresponsible fashion, et cetera, as consumers, as potential employees, et cetera, we do have in some ways the ability to vote with our wallets, to vote with our feet. If we don't like the way a company's acting, we shouldn't buy their products, right? And I see it with a lot of my students. If they don't like the mission of certain companies, they won't even consider working there. They'd rather not work than work at a company that they don't believe in. And so I do think that there's the ability. Now, not everyone can afford to do that. I totally appreciate that.
Yeah.
But there are some levels that we as consumers, as individuals, can take. Back in the 70s, it was shopping only made in America type products, right? When the issue was globalization. I think increasingly we want to, as consumers, we need to understand the mission, if you will, that companies have and are undertaking, and how the products are being made, and how those companies are treating their employees, treating their customers, treating their communities. And do we want to be a part of kind of helping fund that by buying their products, or do we want to be a little bit more discerning? So I think there's an onus on everybody involved in the entire vertical integration, if you will.
And we're going to switch directions here. I want you to talk more about the American economy specifically, and where you see some things headed in the near future. But before we go off of this track, one of the huge questions is being a debt society versus an equity society. And then you think, okay, if you're going to be a debt society, you probably don't produce a lot of things. That's probably be one way to be a debt society. Being an equity society would be, we produce a lot of things. Like China's kind of they're on their way to becoming an equity society. They're already, the projection is already there for them they're an equity society because they manufacture. So kind of manufacturing is tied to being an equity society in many respects. So there's a question like that, but also there's the question of death versus freedom, and I think it makes the American founding fathers, who were very primitive technologically, they lived in very primitive technological times, to ask, give me freedom or give me death, right? And
yeah.
Now we see that questions like that become more prominent than ever, because let's take trucking, for example. Could you say that going to electric electric vehicles when it comes to trucks would make the roads safer? I mean, is that a reasonable thing to posit? Okay. Yeah, I mean, I actually would maybe even agree in some respects. Now, it may not be as safe as we think, and there'll be some kinks to work out. But ultimately, I think that computers will drive cars better than human beings will. Because, again, They don't get drunk. They're not texting and driving. They're not falling asleep at the wheel. They're not going at dangerous speeds just out of their own narcissism. Yeah, okay. But, I mean, isn't there's a level, number one, the truckers lose their jobs. And I think that's one of the markets that we can certainly look at and say AI is going to completely shatter the American truckers, industry, because it's just going to be, I mean, AI cars don't need to eat, sleep. I mean, it'll become very cheap to pay for the service, to run the software. It's going to be so cheap. It'd be like downloading Microsoft Word. You $399 for the entire company, and you got a fleet of 10,000 truckers, right? I mean, basically, essentially, right?
Sure.
So the truckers are finished. The question is, what level of freedom are we willing to give up in pursuit of this aversion to death? Right? And this is a very spiritual question. I know I'm asking a guy who's an economic genius, but I like to do that on Please Call Me Crazy. If it was a guy who was spiritual, I'd certainly ask him economic questions. But what level of freedom are we willing to give up? Because I'm not willing to bust out all the truckers and tell them we're going to retrain them in fourth industrial revolution technology to be safer on the road, I would much rather people make the choice to drive and act safer behind the wheel. And if they don't do that, we all kind of deserve the consequences of that. We've done a poor job as a society. The answer isn't to run away from humanity. It's kind of like double down. What do you think about that? Let's take a case like the truckers. Yeah, we're making the roads safer. Semis are going to be ran by AI software, but you're going to lose a lot of truckers, and
Yeah.
ultimately you may not be able to drive your own car in shortly thereafter, right? I mean, there's that prospect as well.
Yeah, yeah. I mean, the technology clearly being worked on. I guess I would say right now I'm skeptical that that will happen as quickly as many people think it will happen. Um, for instance, we've had the monorail in Disney World, which is a robotic train for what, 50 years, yet trains in the United States are still not run by robots. Now, there's some frictions there, right? Freight trains now, yeah, we have 200 car freight trains that are maybe only have three people, individuals on board versus decades ago they might have had more than that, and perhaps they should have more than that because if we look at some of the train accidents, et cetera. But
Yeah.
trains are a lot easier to run autonomously than trucks are because trains are on rails, right? And when we're not even fully autonomous on trains yet. And so I think that's the first thing to fall. And so I think it will happen at some point. I just don't see it happening in the next 10 years, frankly.
Okay.
And where we have a massive shortage of truckers. Truckers is the number one, the largest number of employees in 30 of the 50 states in the United States are truckers, right? So it's a huge issue. I totally agree with you on that, and I think it's a huge issue we will face at some point. I guess I just don't think it's going to happen right away.
Mm-hmm.
And if it does, I think the first phase of it happening would be where you would see more truck convoys, where there's one truck with a driver in it and two autonomous trucks following behind that truck as kind of a convoy, as a way to make things a little bit more efficient.
Mm-hmm.
And we're not there yet. Now, as far as like, do people want autonomous cars versus driving, et cetera? I'm all for personal choice on that front, right? I'm all personally. I don't feel safe enough that any of the cars have the right autonomous technology, but at some point, I would love to have a car drive me all over the place, etc. I could care less. I don't really like driving. My son, on the other hand, absolutely loves driving. He goes out and drives just for fun. So for him, yeah, that's taken away a lot of the freedoms, things that he enjoys. So I could totally appreciate from an individual freedom standpoint that's something that he's not willing to part with. It's something that me perhaps might be willing to part with. And I imagine if we kind of extrapolate that across all Americans, there's some that don't mind giving up that freedom. There's others for whom that is like an existential part of giving up their freedom. And so I think that's a part of that kind of ethical debate that I think we need to have. But I think before we even get to that part, I look at it and say, okay, yes, I know there's some autonomous taxis going around certain parts of San Francisco, et cetera. However, we're only talking about in ring fenced areas where we have, we live in the Midwest. There's not a lot. We don't even have, the white and yellow lane marking stripes in most of the roads in Midwest are gone because of the weather, right? It's not clear to me how well autonomous vehicles are going to work in the Midwest when we can barely get them to work right now in warm weather states. It will get there at some point, but it's not clear how that will work.
Yeah.
And on top of that, I just think that we're a long way from. We're still a long way away on that technology. It's being worked on. But like, for instance, if an autonomous vehicle gets into an accident, who's responsible? Is it the person who owns the autonomous vehicle? Is it the autonomous vehicle manufacturer? Is it the software manufacturer, the chip manufacturer?
More
is it
litigation.
The insurance company?
More litigation.
I mean, there's a lot of legal issues that we have to figure out before we can even get to that point of autonomous vehicles on the road. So I just think there's a lot of frictions. That doesn't mean we shouldn't talk about it. Doesn't mean we shouldn't worry about it. It's part of this discussion around, this ethical discussion about how we want things to go. I think it's certainly worth having that discussion. I guess I just see that that's a little bit further out. That I think there's bigger fish to fry right now.
Yeah. Okay. Let's talk about the bigger fish right now. Let's talk about the U.S. economy, where it is right now. Where is it vulnerable? It's particularly the dollar. I definitely want to talk to you about the BRICS. I know that people are afraid, concerned and they're rightfully concerned about the BRIC alliance. I see the dollar as being stronger than many people give it credit for, but I also know that much of currency is driven by participation, right? I mean, the belief in currency is just as much a factor of a currency strength as
Sure.
whatever markets are entangled, right? It's like
Yep.
there's a belief factor in it, and certainly there's a concerted effort right now around the world to restructure what was done in Bretton Woods conference, that the United States dollar was going to be the global reserve currency. I think you see a rejection of that coming out of China, spilling over into Russia, and then Russia going on a recruitment tour along with China to get nations in Africa on board. I mean, India's in the BRICS, but I would argue that right now, at least, Modi is more aligned with a more nationalist, India first type of mentality. Although India has all kinds of issues unique to it. But tell me, what do you think about the U.S. economy right now in terms of its health and stability, and then the dollar as well, and the prospect of the BRICS alliance?
Sure, there's a lot to unpack there again. So, what would I say first of all when I talk about the U.S. economy? I think you have to break it into two issues: one cyclical and one secular. So, cyclical, what do we think is going to happen? What do I think is going to happen over the next 12 months? I think the U.S. economy gets weaker over the next 12 months. Why do I say that? Because the cost of money has gone up considerably. The availability of money has come down considerably. Banks are going to make it harder for people to get money because banks are losing deposits, and for a bank to make a loan, it needs to have a deposit that backs it up. And so as the deposits have left, the banks just can't make as many loans as they used to. And we see that the banks are telling us that. The cost of money has gone up by 5.5% over the last 18 months to 2 years. That historically has always slowed the economy, even when it's gone up by less than that. And I don't see how it's not going to slow it again this time. And so I do think cyclically, I think the economy is going to slow down here in the next 12 months. And that's by design. That's what the Fed has been telling us it wants to do to bring inflation down, et cetera. And I think it's going to be successful. And that's when you talk about don't fight the Fed. The Fed wants to slow the economy. It's got the tools in its arsenal to do so, and it's doing so. Secularly, I think is the other question you're asking, which kind of gets to the idea of the dollar, et cetera. I think secularly, the U.S. economy is weaker than it's been in its history because of how much debt that we have. And when we look at the $32 trillion of debt that the U.S. has, if you add in the unfunded liabilities that we have just at the federal level,
172 trillion.
Yeah, absolutely. The U.S. economy from that standpoint has never been weaker. Okay. And so I think that's something. And when we look at, when we look at the issues of entitlements, which, baby boomers, et cetera, are a huge cohort of the population, and then that's really going to start bringing on Medicare and Social Security, it's going to go in a parabolic fashion here in the coming years. I think that's going to serve to secularly cause a lot of problems for us, and then that means that we're going to have to raise taxes in order to kind of fund that, and that's going to serve to slow down the economy as well. Now, so that kind of all serves to say that the potential growth rate for the economy looks like it will be slower in the future than it has been in the past. Now, when you talk about the dollar, foreign exchange is always a relative discussion, right? So it's not in absolute terms, because it's like, okay, do I prefer the dollar to what? To euros, to yen, to Chinese renminbi, to Indian rupees, to Brazilian real? Do I prefer it to gold? Do I prefer it to Bitcoin? It's always a relative discussion that you have on that. And when I look at all of the other alternatives, many of which I just mentioned, I don't see any of those that I prefer to the US dollar. Does that mean that currency has been and always will be political? And as you said, fiat currency, like anything else, it requires confidence, right? It requires a level of confidence to want to conduct your business there. The fact that we have to pay our taxes in dollars and we're paid in dollars, and the U.S. government has a big military, gives me a little bit more confidence that the dollar is going to be around. But when I look at it versus Europe, do I think the U.S. is in worse shape than Europe? No, I don't. When I look at it versus China, China's in worse shape than the U.S. China's got a lot of debt, a lot of unfunded debt. China's population is shrinking. There's estimates that says by 2100, China's population is going to be less than the United States. And so China's had this miracle of, because of urbanization of the last 20 years and or globalization and then urbanization within its country. And I think that we've seen the peak in China. I think China is going to be on this slow course lower. I think the China that we will see for the next 30 years is the Japan that we saw for the last 30 years. And I'm fairly confident in that. India is a completely different story. India's got very positive demographics. It's got a very large and growing population of 20 to 40-year-olds, very educated, et cetera. It's got its own frictions, historically, a lot of corruption in India. So I think that's a concern. But India's probably got the most tailwinds to it. But when you look at all the other parts of BRICS, Brazil, Russia, China, South Africa, yes, they maybe added Venezuela in last week, et cetera. There's no part of that BRICS that I'd want to own or conduct my business in personally. Will they do it themselves? Perhaps. I think you're right, though. India right now is really just looking for the best deal. It doesn't necessarily want to align with those. It's just really kind of looking out for its own self-interest, and it imports a lot of food from Russia right now. If it could get that food more cheaply from somewhere else in the world, I think there's no alliance there. And India and China do not get along, have never gotten along, and so there's no reason to think that that's a stable alliance. And so I look at that and say the BRICS is an organization that I understand why it's coalescing right now, but I don't see that as something that's going to stand the test of time. You look at Japan's another large economy out there facing a lot of their own demographic problems, et cetera. I don't see an alternative to the dollar. So will the dollar lose a little bit of its hegemony? Perhaps. Will it go below 50% of world currency reserves? I doubt it. And so I just don't see where there's any sort of cataclysmic issue with the dollar relative to all these other places, even though I think cyclically and secularly the dollar has some challenges ahead of it. But they're not insurmountable challenges if we could get the right leadership in place to be willing to answer some of these questions. Unfortunately, right now, it doesn't appear that we have the right leadership in place, whether that be in the administration or in Congress. And so that's what kind of makes me a little bit more downbeat if I look at it objectively.
What are some of those things that you would do with your experience? What are some of those things that you would do if you could have the ear of a future president or senator or congressman or woman? Or the head of one of these agencies? What are some of the things that you would deploy to address the issues that you see with the dollar in the short term, in the entry, the ones that are surmountable, the things that we could positively impact?
Well, I think we need to have a realistic discussion around entitlements. I'm not saying that any entitlements should go away. As we said, baby boomers that have been relying on these to be there when they retire, they should be there for the people when they retire. However, there needs to be some restructuring of this because that's not something that is sustainable, right? And we talk about you mentioned the $170 trillion. We can't afford that. And so if we can't afford it, we're not gonna be able to pay it. And so either they're all gonna go away or we can restructure it and make it so it's a little bit worse off for everybody, whether that be means testing for certain elements, whether that be extending the retirement age to 70 or 72 from 65, staged in over time so it doesn't really impact too many people immediately. And that even kind of filters all the way down to looking at a lot of the pension problems that we have at the state levels, right? And so it kind of filters all the way down. It's just to me, it has to be an objective discussion surrounded by facts that just says we can't afford the path that we're on. So what changes can we make that we can afford this going forward without having to radically alter the promises that we've made to people? And some of those discussions can be had. I mean, and then I think ultimately, to me, it's when we look at the fact that we've got 130% debt to GDP at the federal level, that's not sustainable. The academic studies have been done by Reinhardt and Rogoff, et cetera, suggest that anytime a country's debt to GDP exceeds 100%, that's when we have a crisis, and we're at 130%. We haven't had a crisis yet, perhaps because the U.S. dollar is a reserve currency. But I think that doesn't mean that we're healthy. And so I think we need to really think about what we need to do in terms of shrinking government overall to bring that debt to GDP lower. It doesn't look with some of the demographic challenges that we have that we'll be able to grow our way out of it. And so when we've got too much debt, there's usually a few different ways you can get out of it. You can grow your way out of it, but as countries and especially the U.S. are aging, that becomes more difficult for us to do so, right? We can't really grow our way out of it if the population's not growing. We can restructure. There doesn't seem to be any political appetite to do that. I think that's probably the right way to do it. We can default, and we've kind of brushed up against that with these debt ceiling debates in the past, and I don't think anyone really wants the U.S. government to default on its debt. And the last way we can get out of that is to inflate, and that's the easiest way. It's the most painful way for consumers, but that seems to be the way that our policymakers are choosing to get out of this burden of too much debt, is to inflate our way out of it. And unfortunately, that's the path that we're taking. I would prefer to see us restructure those liabilities so that they become more affordable as a country.
Professor Penn here from MyBookie, and I know as a bettor, you demand perfection, and MyBookie delivers. NFL, college football, and a brand new cash out system gives you options to bet and win all season long. First two legs of your parlay hit, cash out early and place another bet, or let it ride for a chance at a bigger payday. Join the MyBookie family for an entire season filled with daily odds boosts, same game parlays, and super contests. This season, MyBookie has a no strings attached cash bonus that lets you deposit and withdraw quick. Use promo code FPR on a deposit of 50 or more, and you can receive up to $200 in cash instantly to your MyBookie account. Bet your deposit amount once, and you're ready to withdraw at any time. Again, that's promo code FPR to claim your cash deposit bonus. You can bet anything, anytime, anywhere, only with MyBookie.
We're back from that ad. Hope you're enjoying our interview here with the great Rich. He's been incredible and giving us a lot of his time today. We're going to be wrapping up soon, but I want to ask Rich this another macro level economic question, one part current but also historical. And off in the break, I was starting to ask you, and I said that globalization was promoted as this way to create military deterrence, deterrent to war.
Yep.
All of these markets are entangled. There's economic incentive for people to collaborate and cooperate versus go and fight each other. That's now been found not true in many respects. We didn't reach the calamity of World War I and World War II, but we have had continuous war ever since this globalization idea was instituted, and even more so. There seems to be a growing level of resent towards America and the U.S. dollar hegemony as a sort of a conduit to being the bully on the playground out there on the world stage. Now, I don't agree with it necessarily. I think America and the U.S. dollar has brought a lot of good things around the world as well that goes unspoken, especially from these detractors. But now we have a sort of emerging nationalist populist movement, some would like to call it. And you even mentioned it more organically from corporations, and seeing that the trend is to manufacture things closer to where you sell them.
Yeah.
Is it prudent for us, when we think about an academic idea like Mackinder's World Island theory, Mackinder's theory of the World Island, is it prudent for us to slowly but surely detach ourselves from whatever parts of the global economy that we can? Is there any benefit to an isolationist nation? Especially, we talked about India. India has its deal it has to deal with because it's on the landmass with China and Russia and all these players. We don't have those problems. And I'm not saying we abandon India or any of our allies out there in the world, Taiwan, Japan, a lot of the nations in the South China Sea after the World War II became Vietnam. I mean, they became we became a protectorate over them in many ways. South Korea, our European allies, obviously, there's a huge jump ball, I think, right now for Africa and the resources there. But effectively, America has much of everything it needs essentially here between North America and South America. So is it prudent to disentangle ourselves from these global markets over time as a matter of national security and safety, even if we want to try and collaborate with them? Is that a policy prescription somebody like you would get on board with?
I guess I wouldn't get on board with completely disentangling from the global economy. I mentioned before, I thought maybe the pendulum had gone too far in terms of globalization. I think if we look at the entire post-World War II trend for the last 80 years or so, that the Washington consensus, if you will, of where you mentioned that the U.S. plays the world's policemen, and in exchange for that, markets are open to U.S. goods. The U.S. is able to import cheaper product that it wanted. We price things in U.S. dollars so that capital gets recirculated into U.S. markets, which brings down the cost of capital for U.S. businesses and U.S. consumers. It's helped Americans broadly, though there have been pockets, as we've talked about, that have been hurt in that. But it's broadly helped the American economy grow over that period of time. It's helped the global economy grow, right? It's lifted more people globally out of poverty than at any time in history. Is it perfect? By no stretch is it perfect, right? Are there lots of places that could still do better? Absolutely. Is there lots of animosity, as you pointed to? 100%. That's always going to be the case. And it's all directed at the U.S. because the U.S. was leading that fight. And so I think from the standpoint of the U.S. should, in my opinion, U.S. should always look at this and say, what is our own self-interest in this? What are we going? And really, it's a two-way street. What are we getting out of it? It wasn't really clear what we were getting out before. I do think that there's probably more of an argument now than ever of kind of pulling back because, like you said, we are self-sufficient from a food standpoint. We're self-sufficient from an energy standpoint. We're self-sufficient from as we rebuild, at least within North America, our industrial base will be self-sufficient from a manufacturing standpoint. So there is that argument, and then there's less. Then we would be less inclined to see our own self-interest hurt around the world. Now, of course, we do have allies. We have allies around the world that we want to still stand behind and stand with. There wouldn't be, in that world, though, there wouldn't be the need to be the global policeman and be involved in every single incident that there is. But there's a trade-off to that. And the trade-off to that is that capital won't get recycled as much to the U.S., that our inflation will be higher, that our cost of money will be higher, that our economic growth will be slower. That may be a cost that we're willing to pay for these other benefits of being self-sufficient, et cetera. And that's a trade-off that we'll have to make, and people will make that trade-off every time they go to the ballot box, hopefully, if we have the right candidates in place.
Yeah.
But there's no silver bullet solution, right? There's a solution where, yes, the positive is we're not involved in every conflict around the world creating animosity, but the trade-off to that is that our cost of living is going to be higher, and so maybe we won't be able to have as much as we did before. And there's plenty of people that tell you we don't need as much as we had before, right? Anyone that's cleaned out a parent's house that, I cleaned out my parents' house they lived in for 60 years and they had so much stuff, then it'd be really nice if we didn't have so much stuff. I totally appreciate that. So I think there's trade-offs, and I think that's what we'll have to, as a people, we're going to have to answer that. I think the conditions are such that probably more so than any time in my lifetime or yours, we're able to have that discussion where we don't need to be abroad because we do have self-sufficiency on so many levels.
And so, as a parting shot here, and we want to have you back on in the very near future. So hopefully we can schedule some time for a part two. I like to give my family and friends guests a two-part motif now, so we can go one, talk about the current, maybe go back into how you grew up, be a little bit more casual, or some pressing issue that may pop up in the next week, something we didn't get to. And I definitely wanted to get to your time on Wall Street and some of the things that you saw on Wall Street that were good, some that were bad, some that you formed ideas around policy that could potentially help a young senatorial candidate think about how he should be approaching Washington at a time where there are huge questions about Wall Street's involvement and influence over politicians, just as well as just American life in general.
Sure.
But in parting here, and as a segue to our part two, start me off on where you were during the collapse in 2009, and what was it like then for you?
Well, I mean, I'll just tell you what I told when I first moved to London. I moved to London at the end of 2007, and when I moved there, I was taking over our European operations in London, and I told everybody, just so you guys know that every time I make a big life move like this, the economy tends to collapse. And I said that because I moved to Tokyo in 1990, right at the top of the Tokyo bubble. I moved into trade in Asian markets in time for the Asian financial crisis. I moved back to the U.S. in time for the U.S. tech bubble. And so here I was making another life change right in time for what happens to be the great financial crisis. And just so you know, I moved into academia full time right in time for COVID. So just I'm able to hit a lot of these high points just at the right time, it seems. What was it like? I would say that in some ways it was the best place to be, and in some ways it was the worst place to be. London is a unique place in the financial markets that it's the kind of, well, people would say that New York is the center of the world because of New York Stock Exchange and the NASDAQ, et cetera. From a geographic and time zone standpoint, London's the center of the world because you come in the morning and the Asian market is still open and you can see how the Asian markets trades. And then by the time you're going home, you're trading the U.S. market. And so in London, the market's never closed. The Asian market's open and the U.S. market's open. And so the great thing is you get to see all of the different reactions that are going on and have a little bit more cohesive picture of how all the different investors in the different geographies across different asset classes are responding to the news. And I felt like I had a much better picture of what is going on and how people might respond. That's a good thing. The bad thing is you end up working very, very long hours. You never see your family, and you're having to deal with 27 different regulators in Europe and not just one regulator in the United States. And so it creates for a very long day, very stressful day, et cetera. So there are pros and cons. And I'd love to talk about it more, but I mean, I think that the financial crisis was the culmination of a lot of different issues. Were there Wall Street excesses? Absolutely, there were Wall Street excesses. Was there bad policy before, during, and after the Great Financial Crisis? Absolutely, there was bad policy. Were there bad decisions made by consumers along the way? Yes, there were. There was all of the above. And was it a U.S. only crisis or was it a global crisis? It was a global crisis because it was a lot of the excesses we saw were coming from global capital providers and not just U.S. capital providers. And so I think it really was the perfect storm, and it was one that was we're still feeling the ramifications of it, right? It was the great financial crisis 15 years ago, and we're still feeling the effects of it because we started this discussion talking about the Fed, and that was the time when the Fed and all central banks really ratcheted up their involvement in financial markets and in our lives. And so we're still feeling those ramifications. And I think much like the Great Depression in the 1930s really kind of colored generations of not just consumers, but generations of academics and policymakers, I think the great financial crisis is going to do exactly the same, and we'll be talking about it in 50 years and looking back at it. I think it was that monumental of a moment.
Well, thank you, Rich. We appreciate the time, and tell us a little bit about where we can find you on social media. If you wrote a book, am I correct?
I didn't write a book, but you can find me on Twitter at Excell Richard, is EXCELL Richard on Twitter. I do a lot on LinkedIn. I'm out there every day on LinkedIn, and I put what I call a chart of the day. Like I said, I try to demystify finance. I talk about what they're talking about on Wall Street and try to bring it down to layman's terms so they can understand what they need to do in terms of thinking about their 401k, et cetera. And then I write a weekly Substack, which is for all audiences. And it's called Stay Vigilant is the name of the Substack. Again, the goal here is just to demystify and make the topics that we talk about in the economy, in the finance and markets, we try to make them more accessible to everybody. A lot of that stuff, I started writing it for the sake of my students because I would talk about those things in class. Before I knew it, fellow professors, neighbors, friends, former colleagues, everyone was saying, "Hey, I like what you're doing. Can you do a little bit more of it?" And so I have, and I get no material benefit. I get a lot of benefit though from helping kind of spread the good word, if you will, of just making people a little bit smarter.
The great Richard Excell, ladies and gentlemen. We appreciate your time today, brother. We hope we'll get you back soon to give us more updates and more perspectives and insights on the world of finance and economics. We wish you well in teaching your class there in the great city of Chicago. Stay safe, stay warm as the autumn and the winter approaches. We got a cold one ahead of us, despite all of the the global warming never gets warm enough in Chicago and Minneapolis in the winter for us. I invite global warming. It would be great for us, right?
Absolutely.
But we appreciate you, brother. Appreciate your time. Please join us again. For everybody else out there, the fight continues. Godspeed.
Thanks, Royce. Thanks for being here.